Hey everybody, Phil Scott here and welcome back to the Everyday Wallet. Today we're going to be continuing our discussion on whether or not you should be paying off your loans early. I'm going to continue to hold to my statement that you should not be paying off your loans early and instead you should be investing. The interest rate has less than 6%. I'm going to not pay it off early and I'm going to take that difference and I'm going to invest it. So again, I'm going to double down on my statement that Dave Ramsey is wrong when he tells people to pay off their debts and to pay off their mortgage early instead of just making the regular monthly payment. I really do not think that it's a good financial decision to pay off your mortgage early. And we're going to break down some numbers. We're going to look at some charts. We're going to see the numbers in action. So go ahead and smash that like button, subscribe to the channel, and we'll go ahead and get started. As always, like my other videos, in the video description below, there's a link to Webull. Go ahead and follow that link, open up an account, and deposit $100. When you do that, you'll get 2 free stocks valued up to $1,600. Go ahead, check it out today, and see what you can get for free. Here I go again, right? Dave Ramsey's wrong today. I want to put that little caveat in there. He's wrong today because the way the market is today is different than it was when he came on the scene over 20 years ago. In 1995, the average interest rate for a mortgage was over 9%. It was about 9.13%. Well, look at the interest rates today. People are getting interest rates around 2% for a mortgage. That's crazy, right? And so even if you were to take the principles that I'm presenting here and you were to have a mortgage at the 1995 rate, what I'm saying would still apply, that if you have an interest rate over 6%, pay that loan off. And if you have an interest rate of less than 6%, don't pay that loan off. Invest the money instead. Before we talk about whether or not you should or should not be paying your mortgage off early and what the numbers actually say about it, I want to share some of my personal issues I have with paying off a mortgage early. The first issue I have with paying off your mortgage early is you tie up all your extra funds, or the majority of your extra funds, in your mortgage. And should something happen where you need to tap into that money, you can't. You have to get a line of credit against your house in order to do that, or refinance. And I'm not a fan of home equity loans or refinancing a mortgage, and especially if you want to get that money quickly. Refinancing takes several months, but if you take that extra money and instead of putting it into your mortgage, you put it into like an Acorns account or something like that. Check the link below in the video description to get free $5. If you do something like that, then you can have easier access to that money, or use a money market account, a variety of different things that you can do with that money so that you can have access to it in case you need it. The second issue I have with paying off a mortgage early is you can have your money do a whole lot more work for you by investing it or putting it into a money market account, a high yield account of some sort that you can have access to should you need it. You can get a better rate of return on that than paying off your mortgage early. And that's what this video is going to be about, is taking a look at what you can get by investing versus paying off your mortgage early. Let's look at some actual numbers. I'm going to set up a scenario for a mortgage, and then we'll take a look at a chart and see what the numbers look like. For this scenario, we're going to take out a mortgage at the age of 30 for $350,000. Our interest rate is going to be 3.25%. Now keep in mind, at the time of making this video, you can get interest rates about a full percentage lower. With a $350,000 mortgage, a 30-year mortgage, interest rate at 3.25%, your monthly payment is going to be $1,523. Now let's say our budget allows for an extra $500 a month. The question that we have is, what do we do with that $500? Well, option A would be pay extra on the mortgage and pay it off. So let's take a look at that. If we pay an extra $500 a month on our mortgage, we pay the mortgage off 11 and a half years early. That's great. You know, we cut off over a third of the life of the mortgage, and then we're mortgage free, we're debt free 11 and a half years earlier than if we had just paid monthly. We'll have paid $122,831 in interest, and we'll have invested $396,000 into our retirement account. After we do all this, and then we continue to put that $2,000 a month into the retirement account after the mortgage is paid off, all the way until retirement. So after we do all this, we'll have $854 $24,928 in our retirement account. Not bad, right? I mean, that's almost $1 million by paying off our mortgage early, taking $12,000 that first half year and putting that into the retirement account, and then $24,000 every year after that. We can more than double our investment, right? That's really, really awesome. That seems like a great option, but it's not the best option. Consider option B. This is my preferred method. Same mortgage. Instead of putting the extra $500 on the mortgage, we're going to put that extra $500 into our Acorns account, and we're going to get an average of an 8% rate of return year after year. Now, with this scenario, we would have paid $198,359 in interest, but we invested $324,000. Our total at retirement by following my method is $1,447,208. So did you catch what happened with the numbers there? Were you following along? Let's break it down. I'm gonna put this up here on the screen so you can follow along. By investing every month, you're gonna spend $75,000 more in interest. You're gonna pay more in interest by investing every month. But by investing every month, you're actually going to invest less over course of time. Also, by investing less sooner, you're going to have more later. By investing less sooner, you're going to have almost $600,000 more at retirement by not paying off your mortgage. Those are the numbers. I'm not making them up. You can check them. You can verify them if you want. There's a lot of calculators out there. I've just plugged these numbers into some simple calculators that gave me the numbers, and I decided this is the path for me. One last thing to consider is the length of time that you plan on being in your house. I don't know where I'm going to be at in 5 to 10 years. I might be in the same house. I might not be. I don't want to have all my money tied up in this house so that when it comes time to move and I have to put a down payment on another house, I don't have that available. By taking that money and putting it into an investment account, like an account with Acorns, I can have access to that money when I need it, and I can use it how I need to use it. So if we need to move from this house into another house and we need a down payment, I can pull that money out and use it for a down payment. It really boils down to what is right for you. You can do what a lot of financial advisors out there say to do based off of data that's 30 years old with interest rates that were approaching 10%. Or you can actually look at the actual numbers for your unique situation and say, you know what, based off of my interest rate, it makes no sense for me to pay my mortgage off early. We have an interest rate of 3.8% for our house right now. It does not make financial sense for us to pay our mortgage off early. The choice is yours. We just walked through the numbers. Do you want to have financial freedom, or do you want to have more at retirement? By taking that little extra and instead of paying off your mortgage early, you can have almost $600,000 more at retirement. Comment below with your thoughts on this. Do you think it's wise to pay off a mortgage early when you have such a low interest rate? Or do you agree with me that it's better to just make your regular monthly payments on your mortgage and invest that extra into an account that'll give you a good rate of return? Do the research for yourself. I'm just a guy sharing his thoughts and his views and what works for him. Find the mortgage calculator, find the retirement calculator, plug the numbers in, see what works best for you. And as always, hit that like button, subscribe to the channel, that way you can be notified of upcoming videos. And until next time, keep on saving to grow your everyday wallet just a little fatter.